What I'd like to talk about is what I call the 10 most dangerous things people say about stocks. Here's a good one. If it's gone down this much already, it can't go any lower. I remember when Polaroid went from 140 to about 107. People said, if you ever get Polaroid under 100, you got to buy it. You just back up the truck, buy the stock. Stock you get to 110, then rally, fall 103, you go 112, go 105. They said, gets under 100, buy Polaroid. Polaroid broke 100, people started buying it, and within 9 months the stock was 18. No one's ever gone bankrupt without any debt. There's a corollary to that that's even more dangerous. Philip Morris sold for 12 cents in 1951, and then it goes to 60 cents in 1961. How much higher can this go? It's gone up fivefold. They missed the power of Marlboro. They missed there's 220 countries in the world. They missed the cash flow of the company. They missed everything. This stock was a 100-bagger after going up fivefold. But people sold it just saying, how much higher can it go? Just saying it can't go any higher, it's gone this much already. That's very dangerous, and don't use that one. And it's a very bad thing to do. Eventually, they always come back. Here's another one that sucks. That's a technical stock market term we just use only in the stock market. They don't have to come back, but they say eventually they always come back. Not true. Here's a great one. It's $3. How much can I lose? This is a great one. Because get out. I don't have a computer and I can't do high-level math, but just do this one. So let's say your neighbor buys $10,000 of a stock at 50, and the stock's now 3, and you put $25,000 in at 3. If it goes to 0, who loses the most? A lot of people cannot answer this question. If you put $1 billion in at 3, you can lose $1 billion. They blow taps in lots of companies every year. They can go to 0. Here's a good one that helped me a lot. It's always darkest before the dawn. This business is terrible. It's awful. You ought to buy the group. This is not a good way of making money. In 1982, there was 11,000 of those oil rigs drilling those holes all over Oklahoma and Texas and Colorado. We used to have the rig count every week, and the rig count fell from 11,000 in 82 to 6,000 in 83. Well, the rig count was only 1,000 3 years ago. So it went from 11,000 to 6,000 to 5,000, then 8 years later it was under 1,000. The industry really started to turn about 2 years ago. So just saying the business can't get worse. I was lucky enough, in addition to having the metals industry when I started Fidelity, I had the textile industry. These people have been through recessions, depressions, world wars. They've seen it all. There's a great expression in the textile industry. It's always darkest before pitch black. Now that's a good one to remember, because when business is terrible, it can get considerably terrible. It can get terrible to the power of 6. And when I rebound to 10, I'll sell. Here's a great rule. Somebody buys a stock at 10, and it falls to 6. They say, if it gets back to 10, I'll sell. Now, I think the math, 4 and 6, I can handle this level math. I think that's about a 66% return. You ought to buy it. If you think it's going back to 10, you ought to buy the hell out of the damn thing. But they think if it gets back to 10, I'll sell. Now, what you ought to do is never put down a round number, because I think for the next 26 years, this stock will go between 5 and 9 1/4. It'll never get to 10. So maybe put 9 1/8 or 8 3/4. But just saying the stock, if it gets back what I paid for it, this is a very important rule. This is one of the key rules. The stock doesn't know you own it. Remember that. But people treat stocks sometimes like their grandchildren or a puppy. They think the stock knows who you are. Let me worry. I own conservative stocks. I don't have to worry. I own conservative stocks. I remember when Con Ed fell 80%, then tripled. So just because you inherit some stock and it's so-called conservative, like Eastman Kodak fell 75%, IBM fell 75%, don't tell anybody you own a conservative stock. Companies are very dynamic. I don't buy that argument. Here's a very dangerous one. Look at all the money I've lost. I didn't buy it. In the 13 years I ran Magellan, I listed, I think, about 200 stocks, A through L, on the New York Stock Exchange. They went up tenfold or more that I didn't own. And people worry all the time about missing Microsoft, missing Western Digital, missing United Airlines. They spend all their time worrying about stocks they miss. You cannot lose money in a stock you don't own. That's a very important. The only way to lose money is buy a stock, have it go down, and sell it. That's the only way. I missed that one I'll catch the next one. That usually does not work. Buying the next of something usually doesn't work. It's very bad. It's like buying on dips. I think it's always better to buy from dips. I always thought it was a better rule than buy on dips. You may have to explain this to some other people. This is another technical term. You may have to explain after hours what a dip is. Stock has gone up, I must be right. Stock has gone down, I must be wrong. I'm convinced that people do this all the time. They buy stock at 10, they buy a little bit of it, it goes to 13, they now say, they don't know anything more about it than they knew when they bought it at 10. They have no idea what this company does. It's gone to 13. Now, they take a second mortgage in their house and buy it at 13. The best thing that can happen for us is to go directly from 10 to 4 for these folks. It's going to go to 4 eventually, but it goes to 13 in the middle. They're convinced now, they bought 100 shares at 10, now they buy 20,000 at 13. And all the fact is the stock went from 10 to 13 is it went up. The average movement of a stock on the New York Stock Exchange this century, between its high and its low, has been 50%. The average stock in the New York Stock Exchange. So stocks go up and down a lot within a year. And to say this stock is going up means you're right doesn't mean a damn thing. Avoid long shots. These are the companies that, we have this very technical term for this called whisper stocks. These are the stocks that are going to grow hair and make your kid have better spelling, but they're missing, they don't have any sales yet. That's the missing element of the story. The story is sensational. There's no profits here, no sales yet, but my God, if this works, it's going to be the next Xerox, and it's going to help Murr and space and everything. It's a very, very good deal. Now, this is not a long shot, this is a no shot. You have to separate these out. I've tried 30 of these. I have never broken even on a long shot. Never. I've made 25, 30 times my money on some stocks. I never thought about Sallie Mae or MBIA or Fannie Mae or some of the banks or Stop and Shop. I'd make 20 times the money, 30 times the money. I had no idea. I thought the stocks were going north. I had no idea. You look back 10 years later, you say, my God, I made a lot of money in this thing. But once I went into thinking I could make 4 times my money, I've never broken even. If a stock's 3 and it has huge potential, write down the story, take the stock symbol. If it's going to 300, it's okay to buy it at 15. Check in later, check a year later, see if it's still listed, see if you still get a quote on it, see if they still have any earnings yet. But if it's going, write the story down. Some of these work, I haven't heard yet, but maybe they will work. But it's worth tuning in 6 months later. Don't buy it then. Importance of management. Management is the single most important thing in a company. But for an outsider to know great management versus good management versus terrific management versus average management, tough to do. Tough to do. Because you only get an hour at people, sometimes a half an hour. And how do you know what decisions they didn't make? A lot of great companies have been made because the company didn't make an acquisition. They didn't get rid of the division. They don't put in the annual report, we didn't get rid of the tubing division. You don't hear about that. Somebody made a brilliant decision, we're going to hold on to that thing, we're going to fix it, and it's doing great. Now, they might be doing great because some management 8 years ago did it right, or some did something right 5 years ago. That person isn't there anymore. Or they didn't make any acquisitions, or they expanded at the right time. So knowing what management, what they can add to it, it's the single most important thing, very hard to measure. I've always said, I'd like to have a company any fool can run, because eventually one will. And you really want to do that. When I bought Toys R Us, they had the formula right. Any 4 people in this room and me could have run Toys R Us. We wouldn't have done as well as they did. They're spectacular. But for the next 15 years, we had no competition, we had a great formula, we could have rolled with it. They probably would have done 3 times as good. They were the frosting on the cake, but they had the formula right, no competition, the department stores know what they're doing, there was no copycats, and they were going to just roll for the next 25 years. Same with Circuit City. So I want the story to be solid. If management can add anything on top of it, that's great. I want to buy the story. Assume management leaves the next day and they're replaced by the next generation. That's fine with me. If management can add something to it, that's great. I'm not going to buy it because people say they have great management. Because you'll notice great management is always attached to stocks been up the last 8 years. You ever notice that? Because I looked at Reynolds Metals. I used to follow Reynolds Metals. The stock has had the same person run it for like 30 years. When aluminum was tight, they'd say Reynolds Metals has great management. Aluminum going oversupplied, these people are idiots. When aluminum get tight, they say these people are terrific. I mean, it all to do with the price of aluminum. And they keep rating the management by how the stock's doing. It's very hard to measure management. It'd be wonderful to do. If you could spend months with them, really see them in action, then you know, but you don't really get that chance. Be flexible. People have all these biases, all these prejudices. They want to buy high-growth industries, they won't buy financial companies, they won't buy savings and loans, they won't buy companies that start with the letter R. I mean, there's all these rules. They all hurt you. There are great stocks everywhere. There are stocks that are near bankruptcy, stocks in bankruptcies, stocks about to go in bankruptcy. There are companies on the new high list that are attractive. There's companies on the new low list. They're all over the place. They're in growth industries, non-growth industries. Don't cut yourself off to one segment. People have way too many prejudices, too many biases. And I always thought of it, I don't know if the women in the audience see this many times, but I always thought of these buy lists at some institutions. We don't have this for Fidelity. They have these buy lists. I think Kmart got on some of these companies' buy lists 3 years ago. Microsoft may get on it about 12 years from now, but they have these buy lists. And I always thought the buy list is, when you buy a new shirt, you ever look in the pocket and you get inspected by 6 or inspected by 8? Do you ever see those numbers? I mean, I always wondered about that. I always think of those buy lists at those institutions, I see that inspected by 6 and inspected by 8. In fact, I'm absolutely, if somebody call me, you could do it any time of day, has anybody ever got a shirt inspected by 1? I mean, do they retire these numbers? They have a meeting. I've never had a shirt inspected by 1 or by 2. I think they must raise their numbers in a meeting up to the rafters. But I always think every time I get that number in the shirt, I think of these people working off a buy list of rapidly growing companies, only to have unit growth rate of X or 6X or whatever the number is. It doesn't work.